Hello, everyone. My name is Geoff Hsu, and I am the portfolio manager for the Biotech Growth Trust. I hope everyone is safe and well, and I'm very happy now to update everyone on the state of the fund as part of the annual general meeting, which is being held virtually this year. So I want to start off with some historical context. OrbiMed actually started managing this trust back in May of 2005, so we have just celebrated our 15th anniversary managing this particular portfolio. And you can see that over the stretch of time, we have delivered a substantial return for our shareholders. The trust NAV is up 12 times since May of 2005, and this is well in excess of the performance of the NASDAQ Biotech Index, which is our benchmark index shown in light gray, and the FTSE Index shown here in purple. In fact, the Biotech Growth Trust is the #1 performing UK investment trust by NAV since inception, and we hope to build on that strong track record going forward. For those of you who are unfamiliar with OrbiMed as an organization, we are a leading global healthcare investment firm with over 20 years of experience investing solely in healthcare. We do have a global footprint with offices in New York, San Francisco, Hong Kong, Shanghai, Mumbai, and Israel. Currently, we have over $13 billion of assets under management and about 100 professionals worldwide looking for healthcare investment opportunities. In addition to our public equity business, which includes the Biotech Growth Trust, as well as our sister trust, the Worldwide Healthcare Trust, we also have a very successful venture capital business that invests in private companies, as well as a successful structured debt business. So here on page 4, it just shows the current Biotech Growth Trust investment team. Again, I am the portfolio manager of the trust. I have been a portfolio manager of the Biotech Growth Trust since 2005, and I have the pleasure of working with a very talented team of research analysts shown here. We do have 4 core biotech analysts shown below me on this slide, 3 of whom have PhDs in the sciences, and we do think scientific expertise is especially important in investing in biotech. Below their names, we have 2 other analysts who cover adjacent sectors to biotech, Will Sawyer covering specialty pharmaceuticals, and Charlie Steinman covering life science tools and diagnostics, and both of them also contribute ideas to the portfolio. And then below their names, we have our emerging markets analysts, Iris Wong and Nico Liu, who work out of our Hong Kong office, and they are responsible for identifying Chinese biotech companies for the portfolio, and that's increasingly going to be an important part of what we do in the Biotech Growth Trust. At the very bottom, the silhouettes really denote future hires. So we are in the process of expanding our research team, given the opportunity set that we see right now, given the number of companies that have gone public recently. We really want to make sure that we cover comprehensively the entire biotech universe. And so we have been looking to augment our team. We do have 1 biotech associate who will be starting on August 2nd, and likely another associate starting sometime over the next few months. So let me now turn to the investment themes that we see in the biotech sector right now and why we think biotech is such a great place to invest right now. So let me start off with a discussion of COVID-19, since that's probably at the top of everyone's minds at the moment. So biotech, we think, has really proven to be a defensive place to invest during this whole COVID-19 pandemic. And that is because the biotech industry fundamentals are really less affected by the economic shutdowns that have been put in place by governments worldwide to control spread of the virus. At the outset, I would say that we are highly confident that 1 or more effective vaccines and treatments will be developed for COVID-19. There are approximately 150 vaccines and over 250 treatments in development right now. We think a vaccine authorized for emergency use could be approved by the end of this year. And already we've seen 2 treatments that have shown efficacy in controlled clinical trials, Gilead Sciences remdesivir and the generic steroid dexamethasone. And so that's very encouraging in our view in terms of being optimistic that other treatments will also show efficacy in the near term. In the meantime, the impact of COVID-19 on biotech has been fairly minimal. So the sales impact on biotech has been very manageable. Many of the prescription drugs that biotech sells can be taken at home under lockdown conditions. And given the severity of the many diseases that biotech drugs treat, such as cancer, patient demand for these drugs remains robust and will rebound quickly upon reopening of the economy. There have been some minor clinical trial delays that we think are manageable. In particular, new clinical trial initiations have been delayed by a few months due to COVID-19. But fortunately, the financing environment remains very robust for biotech, so companies should be able to finance through any delays. Lastly, it is true that certain biotech companies with COVID programs have outperformed significantly. In general, we have not actively chased companies with COVID-19 programs because we're skeptical about the ultimate revenue potential of those products. But having said that, it is true that some of our portfolio companies do have ancillary COVID programs that have helped share price performance. So Gilead Sciences' remdesivir, Regeneron's antibody cocktail, and CanSino Biologics' COVID-19 vaccine are some examples of this. Overall, we think that biotech should perform well if COVID is brought under control. And even if we are wrong and COVID persists, we believe the sector should outperform other sectors of the economy. So regardless of whether one is an optimist about COVID or a pessimist, we think biotech is a great place to invest right now. Moving on to the political environment for biotech, we do feel that the political environment for biotech has improved relative to last year. So there was significant drug pricing rhetoric from the progressive Democratic presidential candidates like Elizabeth Warren and Bernie Sanders that really acted as an overhang on the sector for much of 2019, and that really depressed valuations in biotech generally. In March, Joe Biden clinched the Democratic presidential nomination, and we think that really took the worst case scenario off the table for the healthcare industry. He is viewed as a centrist candidate. He favors incremental changes to Obamacare rather than an extreme Medicare for all proposal. So Elizabeth Warren and Bernie Sanders did propose Medicare for all, which would have been a single payer, government-run healthcare system without private insurance. And that would have been detrimental to the private healthcare industry as a whole. We continue to believe that a likely scenario after the November election will be a split Congress, meaning that Republicans will continue to control the Senate and Democrats will continue to control the House. It's very difficult to get any sort of extreme legislation passed through a split Congress. But even if Democrats manage to sweep Congress, we think it's very unlikely their majority would be sufficiently large to pass onerous drug pricing legislation. We do think the ongoing COVID-19 crisis does improve the industry's political situation. So given the severe economic fallout from COVID-19, we think drug pricing legislation is likely to be deprioritized in the near term in favor of more pressing legislation to stimulate the economy and reduce unemployment. We also think the COVID-19 pandemic is an excellent opportunity for the biopharmaceutical industry to really improve its public image and show it can deliver significant value to society in a responsible way. And we've talked to many companies who say that they aim to price any COVID-related treatments or vaccines very reasonably. Lastly, I think that as long as the biopharmaceutical industry continues to work on vaccines and treatments for COVID, it seems unlikely that Congress would enact punitive measures against the industry. So overall, we think the sector should continue to do well as these drug pricing headlines abate. Here on page 8 is just a schematic showing the major US presidential election scenarios. The election is scheduled for November 3rd, and we've ranked these scenarios from best to worst in terms of their impact to the healthcare industry. So as I mentioned before, we think the worst case scenario, a Bernie Sanders presidency, has really been taken off the table now. And basically the split Congress scenarios we think are the most favorable for the industry. But even in scenario number 3, where Joe Biden is the president and the Democrats sweep Congress, again, we don't think that their majority, particularly in the Senate, will be significant enough to pass any tremendously transformative legislation. Moving on to the FDA regulatory climate, I've mentioned this in previous presentations, but we think the FDA regulatory climate remains very favorable for the approval of new drugs. One of the principal ways in which President Trump has sought to moderate drug price inflation is simply by having the FDA approve more drugs and let them compete in the marketplace. So his first FDA commissioner, Scott Gottlieb, did institute many policies to expedite drug approvals, including more frequent and earlier engagement with companies to streamline their development of drugs. as well as being a little bit more flexible on the endpoints required for approval. In December of 2019, Steve Hahn became the new permanent FDA commissioner, and he has largely continued Gottlieb's policies. And importantly, the FDA has continued to adhere to its drug approval timelines despite COVID-19. So even though most of the FDA reviewers are working from home in a virtual way, 2020 year-to-date new drug approvals are actually trending at a similar rate to 2019. We also think it's possible that some of the streamlined processes being implemented to accelerate development of COVID-related treatments and vaccines could benefit non-COVID drug applications in the future. So overall, we think this friendly FDA has really reduced the time, the cost, the approval risk for new drugs in development, which has really benefited the biotech industry. So what impact has those policies had on actual new drug approvals? Well, here is a graph showing the annual new drug approvals by the FDA from the year 2000 to 2019. And you can see that the last 3 years shaded here in dark blue have been the most productive in FDA history. So the policies that have been implemented appear to be having a beneficial impact on new drug approvals. But beyond that, I think another reason why we're seeing more drug approvals recently is because we are in an unprecedented era of innovation right now, a golden era, if you will. And that has increased the number of drugs in development. So here is a graph showing the number of late-stage pipeline products by therapeutic area from 2014 to 2019. And you can see that there's been an exceptional 50% increase in the number of late-stage pipeline products over the past 5 years alone. So tremendous innovation taking place. This is being done across therapeutic areas. And that innovation is in part due to a number of new drug development technologies that are in our view, the early stages of reaching their full potential. So on the left-hand side of this slide, we've listed 5 of those new technologies: protein modulators, cell therapy, gene therapy, RNA-based therapies, and bispecific antibodies. I won't go into detail on each technology, but I'd like to emphasize the fact that these are not just theoretical concepts. These are actually technologies generating drug candidates that are in clinical trials, have demonstrated proof of concept, and importantly, are resulting in marketed products. And so on the very right-hand side of the slide, we have shown the marketed products that have been derived from each of these technologies. And the thing I'd like to note is that so far, we only have a handful of marketed products based upon these new technologies. There are hundreds of other drug candidates still in clinical trials, many of which have already shown proof of concept, that are gradually working their way through the drug development process. And so over the next 5 to 10 years, we would expect dozens more marketed products from these technologies to come to fruition. So in our view, we are still very much in the early stages of realizing the full potential of these technologies. Not only are these technologies resulting in groundbreaking treatments for patients, but we think that these drugs actually have significant market potential. So here is a slide showing recently approved biotech drugs, along with the consensus peak sales estimates from brokers of what the drugs are expected to do in peak sales in the future. And you can see that every single one of the drugs on this slide is estimated to have peak sales in excess of $1 billion, which is the traditional threshold the industry uses to define a blockbuster drug. Some of these drugs are actually mega blockbusters. So for example, Trikafta, the second drug on the slide by Vertex, is actually a groundbreaking cystic fibrosis drug, and that has peak sales estimates approaching $9 billion. So not only are the therapies that are being derived from these new technologies providing meaningful clinical benefit for patients, they will unlock quite a bit of revenue potential for the companies involved. Next, I wanted to highlight where a lot of this innovation is coming from. It turns out that the bulk of industry innovation is actually occurring in emerging biotech. So according to data provider IQVIA, about 3/4 of the pharmaceutical industry's late-stage drug development pipeline is being developed by what they call emerging biopharma, which roughly equates to what we call emerging biotech. So you can see at the pie charts at the top of the slide that back in 2003, emerging biotech in light blue accounted for 52% of the industry's late-stage pipeline, And that has steadily increased so that in 2018, emerging biotech now accounts for 73% of the industry's late-stage pipeline. If one goes a step further and just focuses on the next generation biotherapeutics, the therapeutics based on cell therapy, gene therapy, and nucleotide therapy, basically based upon the novel technologies I just outlined, over 90% of those late-stage next-generation biotherapeutics are being developed by emerging biopharma. That's shown at the graph at the bottom. So clearly, emerging biotech is the heart of innovation right now in the industry, and that is why the vast majority of the holdings in the Biotech Growth Trust consist of emerging biotech companies. Next, I wanted to touch on M&A. M&A has been a historical driver of returns in the biotech sector. We have here a graph showing the biotech M&A transactions since the beginning of 2018. If one looks at the transactions that have been announced in the first half of this year, you will notice a slight slowing in activity due to COVID. But I would emphasize the fact that interest from potential acquirers is still very high, and customary business development activities like licensing deals and partnerships appear to be continuing unabated, despite the fact that most people are working from home. Interestingly, despite COVID, we still have seen some outright M&A transactions get consummated, and they are listed at the bottom of this slide. And we do expect a recovery in deal flow as the outbreak comes under control, hopefully by the end of this year. The last theme I'd like to touch on are the biotech opportunities that we're seeing emerging in China. So China is actually the second largest pharmaceutical market in the world. Biotech innovation has historically occurred just in the US and Europe, but we are seeing an increasing trend towards innovation in China. Now, historically, the Chinese domestic drug market has really been focused on specialty generics and traditional Chinese medicines, but a number of developments in recent years are encouraging innovation. Importantly, the Chinese central government has committed to building a biotech ecosystem in China as part of their Made in China 2025 plan. So they are plowing a lot of resources into developing science parks, R&D facilities throughout China. The Chinese FDA has also introduced initiatives to expedite approval of innovative drugs. Third, the Hong Kong Stock Exchange and the new A-share Star Board now allow biotech companies without revenue to go public. Previously, companies had to meet a certain revenue threshold in order to go public. And this is very, very important because, as you know, most biotech enterprises are loss-making. They need to tap the capital markets on a regular basis. This gives them an important avenue to do so. Fourth, the multinational drug industry has increasingly focused on China as a promising growth market. So they're really bringing expertise to the country and investing in the drug development infrastructure there. And perhaps the most convincing sign that quality innovation is occurring in China is the fact that we now have a number of examples of Western big pharma companies in licensing innovative assets from Chinese companies. And we have here on the slide shown 4 examples of those licensing deals. So clearly, that's a great stamp of approval for the technologies being developed by those particular Chinese companies. And again, with a local research team in China, we think OrbiMed is well positioned to capitalize on this innovation trend in China. Let me now turn to the Biotech Growth Trust and talk about fund performance. So here's just a graph showing the performance of the Biotech Growth Trust for fiscal year 2020 that extends from the end of March 2019 to the end of March 2020. And we've denoted the end of the fiscal year with this vertical dotted line. You can see that we did have a strong fiscal year. The Biotech Growth Trust NAV was up 18.5% versus the benchmark NASDAQ Biotech Index, which was only up 1.2%. And we've extended the graph beyond the end of the fiscal year just to give you the latest performance statistics. And you can see that we managed to rebound quite significantly from the broad market COVID-related downturn in March and are really pushing new highs as of the end of June, as well as extending our excess performance versus the index. So what accounts for that strong performance over the past 12 to 15 months? Well, we did implement a number of structural shifts in the portfolio over the course of last year, 3 main structural shifts. First, we began emphasizing emerging biotech over large cap biotech to a much greater extent than previously. given that most of the innovation is occurring in emerging biotech. So emerging biotech now represents 70 to 80% of the portfolio, whereas in previous years, it may have accounted for only 40 to 50% of the portfolio. We do think the opportunity set in emerging biotech has expanded markedly, given the robust biotech IPO market we've had over the past 3 to 5 years. So there are many more emerging biotech companies to choose from now. And a consequence of both of these factors means that the number of portfolio holdings has increased to 50 to 65 because the emerging biotech positions are typically sized smaller to manage the individual stock risk. Second, we have increased the allocation to unquoted crossover investments. So the investment guidelines of the trust do permit up to 10% of the portfolio to be invested in unquoteds, but this has really not been historically a significant part of the fund strategy. With the board's blessing, we have now become more active in making crossover investments. These are basically the last private rounds prior to an IPO, where an IPO is generally expected within 6 to 12 months of the crossover round. Importantly, we will not be investing in early stage venture capital. So we're really looking at late stage private deals with some near-term liquidity expected. And one important point I'd like to make is that OrbiMed's significant venture capital business does provide excellent deal flow in the crossover arena. Third, we have also grown our allocation to emerging markets, particularly in China. So holdings in Chinese companies now account for 12% of fund NAV. Most of these investments have done extremely well so far. We will continue to be selective and opportunistic. And again, we have dedicated research analysts working out of our Hong Kong and Shanghai office, which we think provide OrbiMed with a competitive advantage in investing in Chinese biotech. So here on this page, it just shows the single stock contributors and detractors for the fiscal year ending March 31st, 2020. And I can summarize why the fiscal 2020 results were so strong on both an absolute and relative basis. In addition to the structural shifts in the portfolio that I just outlined, the fund also benefited from the following factors. Number one, we did have a number of positive clinical trial catalysts that benefited the fund. A number of phase 3 trial results that we predicted correctly would succeed. We also had 2 holdings in companies that were acquired through M&A. So we held Raw Pharma and Arcule, both of which were taken out at a 100+% premium. And then we also had strong performance from some of the Chinese IPOs that we participated in last year. So moving on to our long-term track record, here is a table showing the performance of the Biotech Growth Trust NAV versus the benchmark index, the NASDAQ Biotech Index, across multiple timeframes. And you can see whether it's this fiscal year or last fiscal year or the 3-year, 5-year, 10-year since inception numbers, you can see that we have generated excess returns versus the NASDAQ Biotech Index across all of these timeframes. In addition, if one looks at the FTSE All-Share Index at the bottom, again, the Biotech Growth Trust has generated excess returns versus that index across all of these time periods. So here on page 23, it just shows a snapshot of the portfolio as of June 30th. The first 2 columns of this page show our United States holdings. They represent, as of the end of June, 91% of the NAV. So the bulk of the portfolio is still invested in the US. That is simply because most of the innovation in biotech still occurs in the United States. But we still have, we do have a handful of European holdings in the upper right-hand corner of this slide, as well as, of course, our emerging markets holdings on the right-hand side. And in the lower right-hand corner, you can see that cash here is shown as negative 8.4%. That means that as of June 30th, we were 8.4% geared. And we've generally kept the gearing level anywhere between 5 to 10% of the NAV. So just to summarize and conclude, what is our 2020 strategy and outlook? Well, we hope to continue the strong performance of the fund on both an absolute and relative basis with the same strategy that we employed in 2019. So we intend to continue emphasizing emerging biotech over major biotech. We continue to invest in select crossover and emerging markets opportunities. The gearing level, as I said, will stay between 5 to 10%. And so far, this strategy has worked calendar year to date in 2020. The NAV is up about 30% through the end of June, and we're about 8 percentage points ahead of the index calendar year to date. We do believe that COVID-19 should not have a significant negative impact on biotech. The sales impact and clinical trial delays we think are temporary and manageable. We are confident that one or more effective vaccines and treatments will emerge. And even if we're wrong and COVID persists, we would argue that biotech is still a sector that will fare much better than other sectors of the economy. Innovation is clearly the main value driver in this sector. It remains strong. It includes transformative technologies like gene therapy that we think are still in the very early stages of reaching their full potential. The regulatory environment remains supportive of new drug approvals. The drug approval timelines remain intact despite COVID-19. We have noticed some slowing in the M&A activity in the sector, but we think that's temporary and should recover as economies reopen. And it's important to recognize that the appetite among large pharma has not abated one bit in terms of their desire to acquire innovative biotech companies to bolster their pipelines. And lastly, we do think the political backdrop has improved for the biotech sector going into the 2020 election. Joe Biden is a centrist Democratic nominee. He's going to build incrementally on Obamacare. We think the industry work on developing treatments and vaccines for COVID makes near-term punitive drug pricing legislation less likely. And we continue to believe that a split Congress is a likely scenario after the November elections, which will make passage of transformative legislation unlikely. Even under the assumption of a Democratic sweep, we think any majority in the Senate would likely be too thin for any dramatic changes. So overall, we remain very bullish on the biotech sector. We think it's a great place to invest right now, and we are hoping to extend the strong performance that we've enjoyed over the past 12 to 15 months for the balance of this year. So thank you very much for listening, and I wish everyone well.